Let's start off with the level of provisioning, because it's where really focus is drawn every time a Nigerian bank releases results of late. Non-performing loans well below the current industry average. How have you achieved this?
Alicia, good afternoon to you, and it's great to be with you again. When we did a merger in 2007, we implemented a very robust and extensive risk management across the entire business, and part of that clearly is around credit in particular. And much of the pain that you see in the market is due to two particular things. One is in the margin loan facilities, which were to equities trading by individuals and by corporates, as well as in the oil and gas sector. We took a very proactive stance in that in the early part of 2008 and reduced what was to us a reasonably high concentration in terms of margin loans in particular, and saw that reducing to very manageable levels by the time to the end of 2009. So it's about proactivity in that sector and continuation of reasonably prudent and certainly conservative risk management processes.
Well, despite not having to raise your exceptional provisions to the same degree as most of your peers in the sector, your profits fell significantly on last year. So what underpinned this modest performance, and why should the market be expecting improvement from here on out?
I guess we are telling a slightly different story to many other banks in the market, and that story is that our cost structures grew faster than our revenues in 2009. One has to recall that IBTC in particular was a very strong investment bank on which relied heavily on the capital markets, and given what has happened in Nigeria and particularly in the capital markets over the last 18 months, clearly a number of our key businesses have been somewhat under pressure in terms of revenues. At the same time, we've spent a lot of time investing in the future, and certainly investing in scaling up our existing operations, whether that's by way of people or by way of infrastructure. And so we have seen our cost structures rise, but in a difficult revenue environment. So our story is slightly different, but certainly we see that changing in the future.
That scenario then making it all the more important for you to focus on cost management moving forward. To what extent do you expect costs to be contained as we progress through this new year?
Well, I think we do. We clearly, as a management team, are very focused on costs, and certainly you've seen one of our biggest costs is our staff. Staff costs in Nigeria have obviously changed dramatically in terms of rising in the past, which has now softened, obviously, given the market conditions. So we see that we are going to be able to contain our costs. Having said that, we're not in a cost-cutting exercise. We're here to try and build for the future, so we continue to invest in infrastructure. So for us, it's as much about containing the costs as it is about actually growing the revenues, which we do see great opportunities and already see good progress in that respect.
Well, of course, Stanbic has a very strong parentage via its links to the Standard Bank Group, but it remains a small bank in the Nigerian context and has really struggled, some say, to increase market share in the business and corporate banking space since acquiring IBTC back in 2007. How do you propose to achieve scale in Nigeria, and what do you see driving growth moving forward for you to reach those targets?
Driving growth, and particularly in market share, comes in different forms, I guess, but certainly across our PBB business and our corporate banking and commercial banking businesses, one of the key things is network. And as I said, we have been investing in that network. As of today, we've just opened our 110th branch in the country, which you will recognize is almost close to double that it was in 2007. So certainly we see that network as giving us the ability to leverage and grow our transactional volumes, and obviously our customer bases across it. Also importantly is we have market-leading franchise in a number of other areas, particularly in CIB and in our wealth business, and cross-selling those customers, whether they be individuals or the corporates and or the actual customers of our wealth and pensions business, gives us great opportunity to grow. So certainly we see our ability to scale given the investment we've made and that we continue to make, both in terms of ATM network, branch network and infrastructure.
To what extent does your relationship with ICBC in China provide you with advantage over your peers in West Africa?
Well, I think as the world's largest bank, and obviously a subset of that is being Africa's largest bank, as Standard Bank Group, we have significant access to capabilities, be that by way of capital or experience. And given the activities between China and Nigeria and the rest of West Africa, we have to be very well positioned to tap into Chinese activities, both at a customer level in China and in Nigeria, to try and ensure that we can facilitate those cross-border flows. And we are setting up capacity and have set up capacity both here in Nigeria to access those, as much as we have a significant office in Beijing that's looking to leverage off that relationship.